Hello and welcome to the August 2022 issue of the Zavitz and Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joining with us today is your other advisor and my partner, Mark Zavitz. Our last July update I know was a little long, so we're going to try to keep these monthly updates to 20 minutes or so. The first 10 minutes of this update, we're going to talk to you about markets and portfolio performance. And the last 10 minutes, we're going to talk about something topical to you and to our clients and to most Canadians. And this month, we're going to talk about real estate. So let's get started. So what's happened since our last update a month ago? At the beginning of August, we've seen companies report their earnings. And so far, they've had, as a whole, better than expected earnings. So they've been relatively positive. Earnings have been solid, specifically in consumer sectors, which are typically the areas that tend to sell off if we're about to enter a recession. So that's kind of defied the recessionary expectations. Numbers have been in line or better than what market expected. So companies in North America look quite healthy as we head into the third quarter of this year. In all, the average client in our models, be it very conservative, moderate, or growth model, the average client has around a 75% weighting to US and Canadian stocks in North America. So these are the stocks that you own that are posting these good earnings, which is definitely a positive tailwind for performance. And as you can see on this slide, markets have rebounded substantially. Just how quickly things can change for us. The Toronto Stock Exchange is up 2.72% for the month of July. Into early August, the S&P 500 rose 8.45%, mostly on the back of tech stocks that like the idea of lower inflation, and I'll touch on that in a second. While the Dow rose 5.96%, the Russell 2000 rose 9.62%. The Russell 2000 is smaller companies, it's a smaller company stock market index in the United States. So all over the course of the past month, things have turned extremely quickly. But what drove this turnaround? Well, corporate earnings, as I just showed you and just talked about very briefly, being better than expected. The other big part of this turnaround came on the back of the Fed Chairman Jerome Powell and his talks about inflation. So in July, Powell signaled to the market that he believes the U.S. economy might not enter into recession, that he expects inflation that might be actually topping the month of June into July, and that they're going to be what's called very data-driven going forward. Contrary to what the markets were thinking, we're going to be raising rates at 75 basis points to a 1% clip for the next, quarter or two. So that was what's known as a dovish tone. The markets really like that. It seemed to, the data that we're actually getting out now, though, seems to actually kind of contradict. So the data we've been getting in early August contradicts what he was saying in July. And the numbers that have come out are showing that the U.S. economy is getting even hotter. So unemployment in the U.S. has actually reached a 53-year low. That's the data that just came out the first week of August, and it is contradicting Jerome Powell. And he was arguing that a soft landing is likely more possible as the economy softens. Investors over the past couple of weeks are starting to buy into the idea that the Federal Reserve will slow and that will halt its rate hikes into 2023 without triggering a big drop in demand and without triggering a large amount of unemployment. So it'll be interesting to see now that this August data is contradicting what he was saying in July, how the markets react from August into September. There's more data to come out, so it might be a little too early to speculate, but I wouldn't be surprised if we get good data that it actually causes the markets to pull back and that we give up some of these returns and then actually eventually test potentially new lows. And so far, as we have yet to really see some of this new data affect the bond market, this new August data, the more dovish stance from July has resulted in the total world global bond market actually appreciating in value 1% as yields have come down. So if you own bonds for a big portion of your portfolio, such as if you're in a conservative portfolio where you have 50, 60, 70% bonds, that bond portion of your portfolio went up around 1%, and that's good. Finally, gold prices, which are sitting around $1,800. They're down on the year, so they're down from their highs of around 2,100. Commodities in general have been going up, though. Gold's been a bit of an outlier. For the past 2 or 3 months, we've seen energy prices really come down. And I think that's been one of the signals or signs from the Fed in the United States and in Canada, our central bankers. They've been seeing this oil price, these fuel prices and energy prices come down. So, oil was, to refresh your memory, was around $140 a barrel. Now it's trading between 90 to $100. Was trading at 140 when the war broke out between Russia and Ukraine back in March. That's good. That's good for inflation. It means that gas prices, means that energy prices are going to be coming down, and that's a big portion of the inflation calculation that the Fed looks to. But when it comes to gold price, Mark, can you talk real quick about why we own a gold position for the majority of our clients, and what gold does in the context of their portfolio?
Certainly. Thanks, Greg. Just a quick comment. As you mentioned, the oil prices have come down significantly from the highs a couple of months ago, and that really was the main driver of the Toronto stock market only going up 2 or 2.5% in the last month versus the American markets, which have a higher tech component, which were up, 6 to 10% last month. So, anyways, but when it comes to gold, about a year ago we started at a little under $1,800. We got towards the end of the year with some very significant inflation scares and some other issues. The war with gold moved up to about 2,050, and we're back settled down to about 1,800 per ounce, US ounce. So gold has been pretty flat for last year. The reason we hold gold in portfolios is not so much that we're suggesting gold is going to go up. That's why we hold stocks. We hold bonds for income. We hold gold for the most part for diversification. It's pretty much uncorrelated to all the other asset classes. It's kind of like buying insurance. And, fortunately, most of you have a 5 or 10, or maybe some of you even a 15% slice in gold bullion. And, with stocks being down 10% year over year and bonds being down 8 to 10% year over year, having an asset class like gold, which is flat or up 1 or 2%, helps the portfolio returns. We would have expected, Greg, gold to go considerably higher during this turmoil with the war and with the rising inflation. However, gold is priced in US dollars, and the US dollar has really charged forward in the last 12 months. And so that's kind of been a headwind for gold. However, sideways is not so bad.
Yeah. I mean, historically, gold has averaged over the past, we'll call it 100 years, around a 4 to 5% return. So, and it's a non-traditional asset class. So when stocks and bonds are doing their thing, gold is going to be doing potentially something completely different. And when we build portfolios, if we can add pieces that do something completely different, such as gold or commercial, private real estate as an alternative asset class, that's the best thing that we can do for our clients. It's not to have all your eggs in one basket. It's to have some diversification into things that do something different when stocks and bonds are doing their thing. And gold, historically, as well as what Mark was saying, has that insurance component to it. So when the proverbial S hits the fan, gold has historically reacted in a way that it goes up. And that has been, a big reason why we like to have it. It's a safeguard in the portfolio for if something goes wrong. and it has its own return component. And we want to continue to hold that in almost everybody's portfolio, at least for the foreseeable future. So how have our portfolios actually performed? So depending on the model that you're in, we'll call it 99% of our clients, we're moving to a model-based approach. The majority of you are in either the very conservative, the conservative, or the moderate portfolio. Well, at Zavitz and Sykora, the very conservative portfolio over the past month, it rose about 2.39%. The conservative portfolio rose about 4%. The moderate portfolio rose about 4.29%. And the growth portfolio was up around 6.15%. So some decent, nice returns. Case in point, anyone who was, getting a little bit skittish and wanting to go to cash, look at how quickly the market can turn around and deliver some strong returns, specifically the portfolios that we've built. And if you'd gone to cash, you certainly would have missed out on these returns. So how are these portfolios built? Just as a reminder, if you look on the far left side of your screen, the very conservative portfolio has around 50 to 60% of the safe stuff, fixed income being bonds. It's got around 25 to 35% stocks, and 10%-ish ballpark around in gold, which is the insurance portion of the portfolio. In contrast to, if you look on the far right side of your screen, you got a growth portfolio that's around 80% stocks and 20% fixed income being the safe stuff. Mind you, the growth model had a 6% return, and the very conservative portfolio had around a 2 to 2.5% return after fees. The growth model is 3 to 3.5 times more risky than the very conservative model portfolio. So that's why you've got that difference in returns. Before I go to the next slide, anything you want to add, Mark?
No, I think you covered it off. It's just, I think it's nice for clients to be able to see that the portfolios are nicely diversified. And just to remind everyone, some of you we haven't had a chance to speak with individually, but in each one of these areas, there are hundreds and hundreds of holdings. So whether it's U.S. equity, international equity, fixed income, preferred shares, these models, Greg and I built these models so that there is hundreds, if not thousands, of positions, different stocks, different bonds in each one of these models.
Yep, that's correct. Thanks, Mark. All right. So everyone's reading about this. Let's pivot. Let's talk about housing. I know it's on everybody's mind. House prices, obviously they've gone up and up and up over the past decade or so. My generation, if you didn't get in a few years ago, my generation being the mid to late 30s, the older part of the millennial cohort, you're basically screwed unless Bank of Mom and Dad has come in to help you. So that's, given way to the idea that we're in some sort of a housing bubble. And I personally have been spending a lot of time looking into the value of houses, and specifically because I was looking to buy a house some years ago, and I subscribe to the idea that I think we are in some sort of housing bubble. And nowadays, with the way the market has been reacting to inflation, we've seen rates for the first time in about 40 years really start to go up. The questions become, are we starting to see this housing bubble deflate or pop and collapse? Well, I'll get to that in a few slides. I think what's interesting, if we look at this slide, is just how much disposable income is needed or going towards housing. So house prices have really disconnected from disposable income over the past, we'll call it 45 to 47 years. And to refresh your memory on what disposable income is basically your net income. It's gross minus the taxes you pay, and then you're left with income after tax. That's your disposable income. Well, at a much higher rate or ratio than ever before, a majority of a Canadian's disposable income has been going towards housing. And that is obviously denoted here by the fact that house prices have gone up. They used to be coupled with incomes, but they've gone up nearly 400% from the level that they used to be relative to disposable income over the past 47 years. So it's no wonder people are really starting to feel squeezed. It's because all their money, especially if they have a mortgage, is going towards their house and house prices. So that's obviously been something that my generation's felt as they've been looking to buy a home. The other thing that has really stood out to me when I found this this chart is the fact that Canadians have never had so much debt. So, we recently broke the $1.7 trillion residential mortgage debt amounts in Canada. And a big portion of this debt was financed when rates were extremely low. So not only is housing sucking, 400% more of our income than it was, 20, 30 years, 45 years ago. Canadians have never been so indebted. And if inflation continues and rates remain and persist over the next few years, when everyone goes to refinance their mortgage, as they do every 5 years, and they have to do so at a significantly higher rate, it's going to be a huge burden on the average Canadian's household finances. It's going to be a massive drain on household finances. So my prediction is that, rates are likely not going to continue to rise well into 2023. There's a chance that they level off and stay at a high level for, several years. But I think what we'll likely see is that rates eventually go down starting late into 2023. So that means that there's not going to be a housing collapse, because if rates continue to go up and everyone has to refinance all this outstanding debt at a much, much, much higher level because inflation doesn't go down, then yeah, we could see a housing collapse. But so far, we are starting to see some cracks in inflation, although, the numbers in the US are speaking otherwise. I don't think it's time to raise the alarm bells now and to panic to a housing collapse, but it is something that we should be monitoring. And if inflation doesn't go away and gets even worse over the next couple of months in Canada, I mean, we just saw unemployment numbers in Canada, and thankfully, unemployment is actually going up, which is good for inflation. Well, I guess, it's a moving target. So you have to see how this is all going to pan out. But what has the biggest bank in Canada seen, and what are they forecasting? Well, Robert Hogue, who's the assistant chief economist for RBC, he's the one who's usually published in the Globe and Mail or other news syndicates whenever he's speaking on behalf of RBC. Well, RBC has been one of the biggest Canadian housing bulls for the past 4 decades. And this was what I thought was a striking report that he released about a week and a half, 2 weeks ago, end of July, speaking to where he sees housing prices over the next 2 years going. So this, if you look at this chart here, the T is actually the end of the first quarter. So starting as of April 2022, he was expecting housing prices to go down somewhere in the ballpark range of 5 to 6, 7%. And then for housing prices to continue to go down, T2 would be, third quarter of this year. T3 would be fourth quarter of this year. T4 would be 2023, et cetera, et cetera. So for the next year and a half, he's basically expecting housing prices to go down more than they've gone down in the past 40 years, more than they've gone down in any of the past few downturns that we've seen. So anyone who's putting down 10, 15, 20% down payment, or did put down 15, 20% down payment over the past, few months when the markets were at their high, unfortunately, it's looking like as if that they're going to lose the complete value of the equity that they've put into the home that they just purchased. That's okay. It's not that bad if this is going to be your principal residence. But if you did this and it's going to be an investment property, well, you just bought something that went down and you've got potentially negative equity in your home. Well, there's no point in holding something that has negative equity and paying a mortgage for something that has negative equity. I mean, we saw this happen in the 80s and we saw it happen in the early 90s. People walked away from their mortgages. Mark, you saw this happen, firsthand. People, were over leveraged and they decided to move away from their debt. I mean, it's possible. I guess it can happen now. You witnessed it.
Yeah, no, I witnessed it in a couple of different ways. I can remember, in the early '80s when interest rates, because of inflation, got driven up to about 20%. And I can, I was only about 20 years old, but I can distinctly remember, several real estate developers that had over leveraged that lost everything. On a personal note, I can remember when I bought my first house but around 1990, late 89, 90, 91. And I sold it, I believe, in about 97 and bought another home, moved to Fawn Hill. But yeah, I bought it and I actually sold it for, the numbers were much lower. I bought it, I think, for 95,000 and I ended up selling it for 93, 7 years later. So residential real estate does not always go up. There
No,
are some,
no,
there are some troughs and there are some periods of time where it bumps sideways. And as you mentioned earlier, the probability from the January, February 2022 peaks, the probability is that, we're going to see a 10, 15, 20% decrease, depending on where you live in Canada, in the
yeah.
value, peak to trough in the value of residential real estate over the next 12 to 24 months.
Yeah, exactly. And it's worth noting that The Economist was broadly speaking to all Canadian real estate, but there are some pockets of real estate, specifically in Alberta, Manitoba, Saskatchewan, that are benefiting from higher energy prices, and especially out east as well, where house prices are actually expected to remain relatively stable. So if house prices in those markets are expected to remain stable, but the overall forecast for Canada as a whole is that's meant to go down 12.4%, that means that something has to give. And that's likely going to give in areas where real estate is its most expensive, obviously. And that would probably mean that house prices are going to go down more in areas like BC and Ontario. And to your point, from a regionality standpoint, most experts think that could happen in areas where the price to household income ratios are completely out of whack. And it just so happens that price to household income ratios, as seen here on this charts, are most out of whack in the greater Golden Horseshoe and the GTA. So where we are right now, historically, anything above a 7 when it's measured by economists is considered to be extreme. And the expectation is that, areas with lower population growth and higher ratios, well, they can sustain that higher number. So Toronto, for example, has historically been, 5, 6, 7 per 7 ratio number. But if you look at like Niagara, for example, or you look at Hamilton, areas that don't have, lots of immigration. They do have some, but they don't have lots of immigration like Toronto, and they don't have the same income levels as Toronto. Well, I would expect that these are going to be the areas that we see housing prices come off the most, potentially 15 to 20%. So, it's some food for thought if you are thinking of either selling and if you are thinking of potentially buying. Case in point, I like to use a website. It's called Zolo. It's a website for anyone who's interested in checking real estate trends. It has not only listings, but it has local statistics. So Zolo allows a person who's interested in local real estate prices to follow these trends. And I chose Hamilton because it had that out of whack ratio we saw on the previous slide of household price to household income. And the house prices in Hamilton, specifically from the top, you can see here, have gone down already, over the past quarter 14% from where they peaked. And, the projection that Zolo has on their website is that it's going to continue to go down. So it's very much in line with what we're seeing from the RBC forecast. And the RBC forecast obviously being that national forecast. This here, I think, should cause everyone pause who's thinking of potentially buying into the real estate markets that are local to us. It also means that we're entering a seller's market. And for anyone over the past few years who's decided to buy, from an investment standpoint, buy investment properties instead of investing in the market, potentially over-concentrate themselves into an investment asset class like real estate, and that's where they pulled all their money. Well, over the past couple of years, it's actually been a winning investment. That being said, if we look at this historical chart of Vancouver, which is the real estate market that has had the biggest gains in all of Canada, the stock markets have actually substantially outpaced investment properties in Canada's frothiest real estate market. Frothiest being, the one that's gone up the most over the past 30 years, 30 to 40 years, and that's been Vancouver real estate. So for anyone that has over leveraged themselves and bought into these investment properties, if you yourself are one of those people, or someone who might have lots of real estate investments, feel free to tune them into this recording and show them this slide. Or if you want to, I can send you this slide directly that just goes to show investing in the stock market over the long term actually substantially outpaces real estate. It hasn't over the past couple of years, but if you're buying it as an investment, the stock market, although it's slightly more volatile, and I would say going forward over the next couple of years, is likely going to be a much better investment than an investment property. So as we wrap things up here, first and foremost, real estate. Mark, you had some good input when we were talking about what we were going to say here. What was something that you wanted to say about residential real estate?
Residential real estate, if we exclude the last 10 years, and if we exclude the last 10 years and look at the last 60, 80, 100 years, residential real estate goes up at the rate of inflation, which is 2 to 3% on a compound annual basis. And when I had a few clients in the 90s, even in the 80s, 90s, up to 2010, when residential real estate went crazy. And I had a few clients that would invest in residential real estate and turn them into rentals. But it was very challenging, even at the much lower prices. It was very challenging because the lift in the value was very small. These were homes that people lived in. They weren't, back 10, 20, 30 years ago, residential real estate was not an asset class. They're homes. People lived in them. And if we did the math, I sat down with a couple, it was very difficult to break even in rental properties up until the last 10 years. And unless you were a plumber or an electrician or a carpenter or all three, if you tried to make a go of it with residential real estate rentals, it was very, very difficult. The stock market outperformed residential real estate by triple, quadruple on a compound annual basis, 9, 10% compound returns versus 2. Last 10 years, we've had all kinds of things happen with interest rates going from, 6, 7% on mortgages down to 1. We've had the pandemic shift out of the big cities, into the smaller areas where there's less people and there's less risk of disease and there's more green space. Those things are all reversing themselves. And I would caution anyone from these current values to, if we look out at the next 10 years, we don't know how well any asset class is going to do. Maybe they're all going to struggle. Maybe they're all going to do reasonably well. But to, if I had to take an educated guess on based on where values are now and based on residential values being several standard deviations out of whack, which
Yeah.
means way overvalued, possibly. The returns going forward are the probability is the stock market and the corporate bond market is going to outperform residential real estate significantly in the next decade.
Thanks, Mark. Yeah, no, I agree 100% with what you're saying. So, if you yourself happen to be an individual who is holding real estate as an investment, or if you know someone who's holding, real estate, residential real estate, should I say, as an investment, it might be worth it to either caution or think twice. If you're someone who's going to be upgrading, upsizing, buying a new home, but you need the capital of your existing home to finance that new home, my word of advice is make sure that you, because it's a seller's market, make sure that you sell your home first before you buy, because you don't want to be on the hook for a price difference in case you don't get as much as you think you're going to get. So with that, it's been about 30 minutes. I want to thank everyone for your time. Clients of ours, thank you so much for tuning in to our monthly update. We look forward to doing more of these updates every single month for you in the future. If you have any questions, please feel free to reach out to either Mark and I. We're happy to have a chat with you. Thanks so much. Hope you have a great day.
Thank you. Bye, everyone.